7 o'clock. I'm sure there we go. Zoom's telling me the meeting's in progress, so we'll get going. Thanks everyone for dialing in. I'm sure there's a couple more that'll come, but I'll get started anyway. This is the second update I've given to Droughtmaster members. The first one was back in May. So from here on out, I'm just going to try and do a quarterly share market update. The last one took the full half an hour, but these ones will probably be a bit shorter. I haven't timed myself on this one, but it's a few slides shorter, so it'll be maybe 20 minutes or so. Feel free to ask any questions throughout or at the end if you've got any burning ones. But we'll get cracking. Just on the go to the next slide. There we go. I thought I'd just recap on the last presentation for anyone who didn't get to hear that one. And basically, hopefully I showed that Australian shares are a good asset class to invest in. These were the sort of key points from that presentation. They've historically outperformed all other asset classes over the long term, roughly 10% per annum. They provide long-term capital growth and dividend income, liquid assets with a 2-day settlement, so you can sell your shares and get the cash in your bank 2 days later, and low correlation to cattle prices, which is particularly important for Droughtmaster members if they want to invest in shares. And then compounding returns, that's reinvesting your dividends and buying more shares, is a very efficient way to grow your wealth. Owning shares in a business provides an entitlement to the future profits of that business. So I guess what I'm saying there is that company profits drive the long-term performance of share prices and dividends. So there's a lot of economic news and doom and gloom in the world all the time, but over the long period, over the long term, share prices are driven by the company profits. The more profitable the business is, the more valuable its shares become, which is fairly straightforward but pretty crucial investing theme. And the board of directors and management team are responsible for running the business. So the access that we at Morgans get, we've got plenty of clients across the country, and that means that the company managers are happy to come and talk to us because we tend to speak for our clients as investors in their business. So we get access to company managers, and I'll share a bit more of that in the next few slides. So the agenda for today, I'll do a brief market update, what's been going on in the markets over the last little while. And then key profit results from August. So for any company that operates on a fiscal year end, a 30 June year end, like most of us are on our own personal tax, if companies do the same, most of them do, then they report their profit results for that financial year in August. They have to do it by the end of August. So we've had hundreds of company profit announcements over the last month or so, and I'll share with you a few key ones. And then right at the end, a stock tip for the year ahead. So the market update, and I've titled this My Market Update. You'd think that as a stockbroker doing a market update would be pretty easy, but I actually struggled a bit with this section. I tend to not really talk about the market that much. I'd rather talk about companies and profits and what the businesses are actually doing to increase their profits. But so for the market update, I came up with what I've actually done in this chart here is over the last 12 months. And put a few dot points there of the key messages that I've sent to my clients. So the first one there was the all-time high for our stock market, the ASX 200, which is the 200 biggest companies in Australia or listed in Australia. Peaked back in August, so just over a year ago, and it's been kind of pretty choppy since then, particularly since January. Pretty volatile market. Number 2 there was right at the end of January, and I put out a note to my clients. I put out probably at least weekly, sometimes two or three times a week, but usually at least weekly notes. So this certainly isn't everything that I've communicated to my clients over the last year, but it's a few key ones. So number 2 there at the end of January was coal is not a dirty word, and I'll come back around to that at the end of the presentation. Number 3 there was buy the dip, and that was in early February or late January as well, when the market was absolutely fixated on the fact that interest rates were going to go up because inflation was going up, and the market fell pretty quickly. And I said buy this dip, and that was the right call for about 3 months because the market had a pretty good rally, almost back to record highs in April, and then another fall in May. Same reasons, inflation fears, and this has got nothing to do with the companies that people are invested in. Share prices fell off because everyone's fearful of interest rates and inflation. And at number 4 there, I said be a buyer today. That was my key message in my email to clients. Number 5 there, just after that, I did the first presentation to Droughtmaster members, but it was more of an overall kind of introduction to the market. I didn't really talk too much about companies. like I will today. And then number 6, that was when really, fear was at its worst. And the title of my email then was "The Best Opportunities to Make Money from the Share Market at Times Like These." And that table down the bottom there is part of that email that I sent, that last one at number 6. This was I went back and looked at all the bear markets that we've had in the last 30 years. And the NASDAQ, which is a US index mostly of technology companies, has had the most. It's had 5 bear markets. Now, a bear market is when it's fallen 20% from the most recent peak. So the NASDAQ's had 5 bear markets in the last 30 years. The dot-com bubble back at the turn of the century, the NASDAQ fell 74% over 2.5 years. And then from the bottom, that 1-year return was 52%. This S&P 500 was also in a bear market. Not quite a strong rally, but didn't fall as far. The Dow Jones is, so the S&P 500 is the 500 biggest companies in the US. The Dow Jones is a list of 30 big industrial companies in the US. So those first 3 are US markets. And then the bottom 2, the ASX 200 is kind of the benchmark for our market. And the small ordinaries is basically cutting out the top 100 companies. So it's the next 300 that are the next 300 size companies. So that's the return profiles out of all of these big market corrections or bear markets. So the dot-com bubble bursting was pretty bad in the US. It wasn't too bad here in Australia. The global financial crisis was truly global, and everyone hurt, and everyone recovered pretty well. It lasted for 1.5 years, and then the 1-year return was very strong. The 2018 taper tantrum, the ASX didn't quite get into a bear market, but the rally was strong. The COVID-19 crisis was the shortest and sharpest of them all, and the return was also very strong. And then this one here, 2022 inflation, we didn't quite get into a bear market, down 16% at the bottom in June. And already since the bottom so far in the last 2 or 3 months, US markets and Australian markets are up pretty strongly. So I guess the message is, well, my email saying that it was buy the dip, and that was right. I mean, sure, if you bought at 3 and 4, you might still be underwater, but if you bought at 6, you're doing well. And buying the dip is the best way to make money. Well, certainly how I think it's the best way to make money. It's very hard to do. The prevailing headlines at the time when these things happen, when markets are volatile and share prices are falling, is that it's going to go on forever and it's going to be the end of the world, and everyone's sort of pulling their hair out and panicking and selling. The thing to be doing is buying. It was the same in the COVID-19 crisis. That was pretty dramatic falls, and buying was the right thing to do. And I think that this time is as well. I'm pretty confident that June, the share prices that we saw in June will be the low for some time. And this little pullback that we're just seeing after August reporting season looks like it's going to be another buying opportunity. But that was my market update. It's probably not a traditional market update. So the next couple of slides I've pulled straight from our research team. Their kind of latest presentation slides, and I'll just read through a couple of these that might need a little bit of explanation. But their views are that rates are going to rise, but how does the story end? So that we expect they're going to be over 3%. This is the RBA cash rate, over 3% by the end of this year. So volatility will probably remain elevated in the short term, and the terminal rate in October, will be going to be at 3.5%. Is our expectation. That should see risk appetite improve, so share prices should stabilise. Strong labour markets, commodity prices, and sound household balance sheets will absorb some of the economic pain. We see a cyclical slowdown, not a recession, so that's pretty key. The US potentially could go into recession, but we think that Australia won't. The margin of safety, and that's FY23, so that's the current financial year earnings. But is it enough to weather the incoming storm? So Australia is not the US. We don't have a problem with expectations. In fact, expectations for our market profits for our listed companies are fairly low. So the reasons that forecasts could turn out better than the current expectations are that economic conditions are sound. Lack of company guidance means that analysts are cautious on their expectations. Less divergence among analysts means that there's probably greater confidence in those expectations. And fewer negative trading updates in May, July indicate that there's a more stable operating environment than maybe what's feared. A lot of that's a bit of jargon, and this is why my thing was a bit different to the research thing. Valuations to keep buyers on the sideline. I wouldn't take this be too excited about this, but financial year 22, so the last financial year, earnings per share, that's EPS, earnings per share growth of 21%, followed by 6.6% expectations next year, would normally be meaning that everyone should be buying, but I think everyone's kind of still fearful of this inflation story. Normal is not the environment that investors are operating in. So buy the dip mentality is yet to shake out growth industrials. I still think it's the right strategy as per my previous slide. Solid dividend yield on offer, but not where you would expect. Usually the banks are big dividend payers, but lately it's resources companies that have been. BHP and Woodside paying really big dividends, and so are companies like Horizon and AGL Energy, so ones that are resource linked. Record dividends being paid right now following last month's reporting season. So our research team's kind of current stance is overweight quality growth companies and large blue chip companies, healthcare and resources, and underweight housing related exposures and car and autos. I don't particularly agree with that, but also underweight long duration growth. And by long duration growth, they mean technology companies that aren't yet profitable, but they're hoping to be, or there's expectations that they will be in 5 years' time. They're the ones that are pretty challenged at the moment, and I'm not sort of buying into that sector of the market. So I agree with the research team there. With a challenging economic backdrop and a lot of monetary tightening left to run, value and quality remain the factors we expect to be most resilient. So sticking to the quality end of the spectrum. We don't expect the US dollar to keep its leadership and see the Aussie dollar trending towards 72 cents. And rounding all of that out, these are our economic forecast for the next couple of years. So GDP growth of 4% for this year, and then slowing to 2.5% and 2.1% next year in the years ahead. CPI, so that's the core inflation measure, 5.8% this year. So it's currently, I think, 6.1%. So we're expecting it to just taper off a little bit by the end of the year, and then really taper off properly in next year and the year after. Unemployment to fall a little bit from record low levels, 3.5% last print. And the central bank rate, so the RBA cash rate, we expect 3.25% at the end of this year. It's currently 1.85, so that's another 150 basis points or so, 140 basis points higher than where it is now. So you can expect the RBA cash rate to lift by 50 basis points again next month and the month after, I would say, and again before Christmas. And then that to taper back to 3% by 2024. Certainly high in the context of the last few years, but I don't think it's really a setting for panic stations. And as just previously mentioned, the US dollar, we expect that to appreciate against the greenback over the next couple of years as well. The final slide from our research team. These pretty small writing here, so I won't, you won't be able to read it, and I won't read it all out. But these are the key reporting season takeaways. I'll just pick a couple of sectors that I thought were interesting. So for the banks, the net interest margin, which is basically the bank's earnings, so they lend out money, so the profits or the income that they get from lending to people minus the money that they have to pay out to depositors, so people with term deposits. That's the difference is the net interest margin. So they're going to get a tailwind from that from higher interest rates. Deposit funding and credit growth offset somewhat by fierce mortgage competition. So there's plenty of competition in the banking sector. A lot of concerns that margin pressure could re-emerge later on as the rate cycle matures, but no major surprises in the dividends from the major banks. So they're still pretty rock solid dividend payers. And the travel sector, the timeline of the recovery has once again been pushed out due to capacity constraints and labour shortages. So it's not really a COVID issue anymore. It's just the fact that this labour is hard to come by. However, clearly the recovery is underway. Qantas noted that international capacity is expected to return to 100% of pre-COVID levels next year, and demand is very robust. And then resources, elevated, relative commodity prices and volumes continue to overshadow escalating costs. So they're still making plenty of money, even though the costs are going up. In the agriculture and food sector, favourable weather and demand profile and prices providing a strong tailwind to the sector. So that's GrainCorp and Treasury Wine Estates that are under our coverage, offset by rising costs for the likes of Bega Cheese and Ingham's Chicken. And then the automotive sector, the backdrop for automotive is as good as it gets, which sort of flies in the face of what they were saying before on their overweight stance on the automotive sector. Conditions have remained consistent, no deterioration in demand profile to date. So supply is the only real issue there, and getting cars into the country is difficult, but demand is very strong. And then there are a few kind of negative themes from the reporting season. In supermarkets, demand continues to be robust, but labour costs is a pretty recurring theme across all sectors. Same with building materials, and same with utilities. So on to a couple of stock-specific slides, which is my kind of bread and butter. I like talking about stocks rather than talking about the market. So I've picked half a dozen companies here. You'll recognise most of them, if not all of them. BHP Group, the big Australian, is the biggest mining company in the world. Very strong result with a final dividend that beat our expectations. It's better positioned than most, and that's due to its diversified commodity base, I guess. So that pie chart there shows the EBITDA, which is earnings before interest, tax, and depreciation and amortization. So essentially their profit. Their breakdown, so 54% comes from iron ore, 25% from copper, 18% from coal, and then small amounts from a few other commodities. So it is still, even though it's sold its petroleum business to Woodside, it's still a pretty diversified business, and much more so than the likes of Rio Tinto and Fortescue Metals, which are almost wholly reliant on iron ore now. And coal has been the highly profitable division over the last little while, and that's why BHP, I think, is a much better investment than those other, more pure play iron ore producers. There's a $12.5 billion cash dividend getting paid to BHP dividends over I think it's the end of this month or early next month. Free cash flow was $24 billion, 20% above our expectations, and net debt for the business is now only $300 million, which might sound like a lot, but for a company that's worth $192 billion, $300 million of debt really is a drop in the ocean. So I don't think there's ever been a point that BHP has been in a net cash position. It's always had some debt, but that's as low as I've ever seen it compared to its market cap. A really fantastic profit result from BHP. That share price fall there from 42 down to 37 odd dollars. That's when it went ex dividends, $2.50 per share. So that really, when a company pays a dividend, the share price usually falls by roughly that amount, basically because the dividend has been paid to shareholders rather than being still part of the business capital structure. But we're still very bullish. We've got a $48 target price, and it's currently trading below $40. Happy buying BHP. Commonwealth Bank was a pretty strong result as well. Full year cash profit of $9.6 billion, up 11% on last year. And final dividend of $2.10 per share, which is 10 cents bigger than last year. Probably the best thing from Commonwealth Bank's result is their economic outlook. So it's the biggest bank in the country, and Matt Coman's the guy who runs it. He'd have a pretty good idea of how the economy is placed. And these comments here were pretty insightful. So strong fundamentals for the Australian economy, low unemployment, lower underemployment, and high participation rates, strong mining investment. Inflation's a challenge, and fiscal position is favourable versus many other countries. So Australia really is the lucky country, and compared to a lot of others, Europe, the UK, the US, we're in a much stronger position. The tightening cycle is already having a significant impact, which is probably different to what most other companies are saying. Most retailers are saying that they haven't seen much of an impact on the tightening cycle yet on consumer spending, but in CBA's books, consumer confidence is down substantially. Spend is moderating, more so for discretionary items. So that really is against what retailers are saying. Savings rates and housing prices trending down, but they're from really high levels. They're expecting a short, sharp cycle, significant divergence in forecasts, the lag effect from already announced rate changes. So even though that the rates are already, they've only just started going up, people are tightening their belts in expectation of it getting tougher. Global growth to slow considerably. Recessions expected in the US and the UK, but not here in Australia. Wesfarmers, owner of Bunnings, Kmart, Officeworks, one of the best diversified retailers in the country. It was a pretty fantastic result, particularly from Bunnings. So over the last 3 years, their sales are up 35% and their profits are up 40%. And that margin expansion or high margin of that business is shown in the pie charts on the left. So the top one's revenue. 50% of Wesfarmers' revenue comes from Bunnings, 27% from Kmart, 9% from Officeworks, and 14% industrials. But Bunnings is 63% of profits. So the margins in Bunnings really are fantastic, and it is genuinely one of the best retail businesses in Australia. Kmart, has had its own own issues, and Officeworks has been pretty steady. But Bunnings really is the jewel in the crown for Wesfarmers, and as we all know, it's a great business. Santos is one that most people should recognise, one of the biggest oil and gas companies in Australia, and now a global player after it bought Oil Search, which is a PNG oil and gas business. I rate the CEO, Kevin Gallagher, is a Scottish bloke, very highly. His comments on stemming from the war in Ukraine, that structural change in nation's energy strategy from ESG at any cost to secure supply at any cost is going to underpin demand for oil and particularly gas going forward. And I agree with him, and our research analysts agree with him as well on that point. So oil and gas is certainly a good sector to be invested in. I'm most bullish on Santos. They didn't pay as big a dividend as we were hoping, but instead of paying a dividend, they're buying back shares, which is actually a good thing for existing shareholders. If you don't sell your shares back to them, you hold on to them, then the future profits are split amongst fewer shares, and it means you get a bigger share of them, a bigger share of those profits. So buybacks are good for share price appreciation. Dividends are good for cash in your wallet. But another strong result from Santos. Domino's Pizza was, I thought I'd pick one that wasn't a particularly stellar result. Their same-store sales were down just under 0.5%, down 0.3% for the year. So it wasn't a fantastic result. However, growth will improve after this current quarter that we're in, and inflationary pressures will pass. So we think that this most recent profit result for Domino's is going to be the worst we'll see for many years, and that, to me, back on the buy the dip strategy, is a pretty good reason to be buying. If we think this is the bottom for earnings, then it's also the bottom for the share price. And why to buy Domino's? Long-term store rollout, resilient consumer demand, and superior operating efficiencies. It really is a fantastically run business. Don May started as a delivery driver, and now he's the CEO of one of the biggest retail, or one of the biggest fast food chain businesses in Australia and around the world. Along with their result, they made an acquisition of franchises in Malaysia, Singapore, and Cambodia, and there's potential for that market to be 600 stores. So there's plenty of runway for growth for Domino's. And finally, Lovisa, which you might not have heard of. It's a fast fashion retailer. They sell $20 necklaces and $10 earrings, which might not sound like the greatest investment in the world, but this business really is a fantastic one, and one that I own. In fact, in full disclosure, it's my biggest personal shareholding now that the share price has gone up so much since the result. So the key comparable, I guess, for Lovisa selling fast fashion jewelry is Zara, which is owned by a Spanish company called Inditex, and that top right share price chart is Inditex over the last 20 years. So if you think that Lovisa is going to follow the same path, Lovisa is right at the start of that graph, and it went from €3 to over €25 over the course of 15 years or so. And these charts at the bottom show the comparable kind of store rollout story. If you say that Lovisa is going to do what Zara did 15 or 20 years ago, then it could really go from here. So it's already had a really good share price run, Lovisa, after a really good result. The profit was up 110% on the year. They got plenty of cash and no debt, and rolling out stores very quickly, 85 last year and another 22 already this in the first 2 months of this year. So even though the share price has gone bananas, I'm certainly not selling, and I'm happy buying for clients who happy with a global store rollout story that really could be a multi-bagger from here. You make multiple times your money. So that's half a dozen profit results, and I'll just finish with a stock tip for the year ahead. And it's New Hope Coal, and this is a dividend tip rather than a share price tip. The share price has gone up a hell of a lot over the last 12 months, but the dividend is incredibly strong off the back of really strong coal prices, and that feeds back into what Kevin Gallagher was saying from Santos. The energy crisis in Europe means that now everyone wants coal. It was a dirty word a while ago, and now it's not. But New Hope's got plenty going for it. So the coal prices that they're getting are through the roof. Our expectations are, so that bottom right graph, our expectations are for coal prices to moderate substantially over the next 2 years. And even with those lower forecasts on coal prices, our base case target price is $5.50, roughly where it's trading now. But our base case gross dividend yield for next year is 33.6% at the current price. So I've never seen a dividend yield that strong before. Usually they're in the order of 5 to 10%. For a base case dividend yield to be 33.6% for next year, plus 18.5% if they pay up $1 per share in a couple of months. That is my tip for next year. As I said, the share price has already had a strong run. This is a dividend story, but if coal prices remain elevated, and we think they will, I think this Ukraine crisis has got a lot to play out in terms of energy markets, particularly in Europe. Then coal prices could stay elevated, and New Hope's dividend could be pretty incredible. And last time I picked a coal stock for my clients was that email back in January where I said coal is not a dirty word. The one that I picked was Whitehaven Coal, and this is what it's done in the last 9 months or so, from the 24th of January. So down there was pretty much the bottom. Down here, it's gone from below $3 to $8.50 closed today, and it's paid a couple of dividends along the way. So I've got a reasonable good form this year in coal, picking coal stocks. I don't know if New Hope's going to do the same thing in terms of share price, but I think the dividend will be incredibly strong. And that pretty much wraps it up. I got my contact details there if you want to get in touch. I send out, as I said, a weekly newsletter to my clients. I'm happy to add you to the list, and feel free to get in touch if you need to, and ask any questions now or later if you've got any burning ones. Thank you. Oh, actually, before you all go, I did have one little quote. So back on this, I think that was it. Yeah, okay. No more slides. But just before I'll leave you with a Warren Buffett quote rather than anyone waiting for anyone to ask me questions. I know everyone gets a bit nervous wanting to ask questions. So when I sent this email out, the best opportunities to make money from the share market at times like this. This is a quote from Warren Buffett in his 2016 letter to shareholders. Every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold. When downpours of that sort occur, it's imperative that we rush outdoors carrying wash tubs, not teaspoons. So buy the dips. And I'll be at Rocky for the bull sale next week. I'll be presenting an award, I think, on Monday night, a week from now, at the Drinks with Droughties, and then I'll poke my head in and say good day to everyone on the first day of the sale on Tuesday, and then I'll be around through Central Queensland, tripping around seeing clients for a few days. So if you're around Rocky or Emerald next week, I'll be happy to catch up. And again, for the Roma bull sale in October, I'll be heading all the way out to Quilpie to see clients and popping back through in Roma on the way back through. So I do get around a bit, and I'd be happy to meet anyone that wants to. Thanks.